Hi guys, welcome back to the channel. My name is Brad. This is the Firefighter's Financial Toolbox. Today we're going to talk about a question I got from a viewer on leaving a legacy to his heirs. Now this gentleman sounds like he's won the race. He's done well. He's got enough money for his retirement. He's not going to need all of what he has, and he wants to know what is the best to leave to his children and maybe his grandchildren. So the first thing I asked him was, well, what kind of assets do you have? Now, when we talk about assets, we talk about three different kinds, right? We talk about taxable, we talk about tax deferred, and we talk about tax-free or Roth assets. And obviously the best thing to pass on is the Roth assets, right? The tax-free assets, because whatever the value of that is, they're gonna get tax-free. And it can grow tax-free for their lifetime. They will have to take RMDs, but it's tax-free. So it came down basically to, and this gentleman, it sounds like, mostly has a lot of 401k assets, so they're tax deferred. I asked him if he has any taxable assets, and he said yes, he has a fairly sizable taxable account. So let's talk about that. As you know, if we give assets that are tax deferred, not only will they have to, thanks to the CARES Act, have to spend that money within 10 years, but it's going to be taxed as ordinary income. And if it's a sizable account, let's say, let's go to the whiteboard. Let's say that this gentleman has a 401k and it has $50,000 in it. Okay, so $50K in the 401k, we know that he is going to have to, not only when that comes out will it be taxed as ordinary income, but they'll have 10 years that they have to go, so $5,000 a year, right? $5K a year, whether they need that money or not. Now that's not a big one, but let's say it was bigger. Let's say it was $250,000. Right? Let's say he has the 401k and he's given it and it's got $250,000 in it. His heir gets that, they'll have to take $25,000 every year, whether they need it or not, and that's going to be taxed at whatever their ordinary income level is. So let's make it 32, which is what we have. 32% tax bracket, right? He's going to lose a third of that money every year to taxes, all right? So I told him it would be better to use his taxable assets, you guys. And the reason it would be better with his taxable assets is because of a step up in basis. Now, before we get into step up in basis, let's talk about cost basis. What is cost basis? It's the original value or purchase price of a stock or an asset for tax purposes. So what that means is, let's say that I bought Apple stock. Let's say I bought Apple stock and I bought it at $200 a share. And let's say I bought 50 shares. So I have $10,000 in Apple stock, right? And time goes on and values go up as they do. And now it's appreciated to $300 a share. Right? Now I still have 50 shares, and actually I may have a little bit more because of reinvestment, but for simple math, let's just say it's gone up to $300 a share. So now I have $15,000. I have $5,000 in appreciation, right? So if I were to sell that asset, I would have to pay tax on the $5,000. Now, whether it was short-term or long-term, and we're not going to talk about that, but obviously long-term is better, right? Because then it's 15% for most people. But if, let's say I had that same Apple stock, and let's say, without going into share price, let's say I bought it and I had $10,000. And now it's appreciated because I bought it in the 90s, and now it's worth $100,000. So a huge appreciation in the value of the price. We're talking about $90,000 in difference, right? Well, if I passed that on to my heirs at the time of my death, they would adjust the cost value to $100,000. So this $90,000 would not be taxable to my heirs at all. Meaning that they would start off with the full $100,000 profit. Okay, so let's define step up in basis. Step up in basis is a readjustment of the value of an appreciated asset for tax purposes upon inheritance. The higher market value of the asset at the time of inheritance is considered for tax purposes. When an asset is passed on to a beneficiary, its value is typically more than it was at the price bought by the original owner. The asset receives a step up in basis so that the beneficiary's capital gains tax is minimized. A step up in basis applied to all the cost basis of property transferred at death. So this is important to remember, you guys. This only happens at death. Now, I know that sounds kind of morbid, but here's what I'm talking about. If I were to take that same asset, if I had that $100,000 and I decided to gift it, they would be responsible for the taxation on the capital gains. So this is something that we do not want to do. For a lot of people, if you're new in the investing game, this is a long ways away. But these are the kinds of things to think about when you think about your overall financial plan. You should plan for retirement, plan for kids' schooling, and ultimately plan for what you want your assets, if there are any left over, to go to your heirs. And if you do want that, then passing on with the step up in basis is a good plan. Now, this doesn't apply to everybody because not everybody has all three types of accounts. But these are the kinds of things you should think about when you're setting up your plan, because prior planning prevents problems later, right? All right. Anyway, you guys, I hope this wasn't too over the board. I hope you got something out of it. If you did, drop me a like. If you're not already subscribed, you know the deal. Hit the red button, ring the bell. You'll get notified every time I make a video. We'll see you. Thanks.